So this year's been anything but smooth. In fact, the market's done nothing but throw curveballs at us. And in this episode, we're going to talk about one of the curveballs that's landing in our mitt right now. So stick with me. My name is Brian Cannon, and welcome to Markets in 5. All right, so let's start off with a quick update on the market. So obviously the market's still in a downtrend, lower highs, lower lows, and until that trend really breaks, we may play some bear market rallies, but we'll be very careful on the amount of risk that we're putting out there and the types of risk we're putting out there. So we're not going to be buying into the really crazy growth stocks that are still hyperinflated their valuation. So because those are the ones, they'll rise the fastest off the bottom, but then they'll also be the ones that just crumble. People don't want to pay for future earnings on growth that may not happen. So sticking with value stocks, sticking with dividend players, but also paying attention to their individual trends is extremely important, and that's what we're doing. So I kind of marked the S&P 5 here and 500 in the various levels, kind of a red, yellow, green, almost like a stoplight. We don't do a whole lot before, while the red light's on. We hit the green, the orange light or the yellow light, and it's starting to get interesting. And certainly, if you got above the level there in the green, it would be go. But at the same time, the S&P will have, as I discussed this in a stock market update I put out last week on our website, bear markets can have rallies up to 20-25% sometimes. So we have to play those, but if they can't get above certain levels, then we just simply pull it back off. All right, so the curveball I was talking about really refers to the 10-year Treasury yield curve. So when the 2-year is starting to rise faster than the 10-year Treasury yield, you'll see the yield curve starting to flatten, right? So when this line starts to drop, that's a flattening of the yield curve. Now, when it inverts, that means that the 2-year is actually paying more than the 10-year. And in every time that it's done that in recent history, in the last prior several recessions, it's preceded a recession and an economic recession in a bear market. So this just kind of shows you that we are right in the midst of all this. So it's important to watch, to be aware of, and just know that it's a curveball, it's a warning sign, it's a shot over the bow, and we need to pay very, very close attention to it. So in that, I think it's important to not only just look at the Treasury yield and say, okay, we need to be careful. I think it's also important to go back in history and kind of see what's the time frame associated with it. So if we go back and we look at the last two major yield curve inversions, it touched down just prior to the pandemic drop last year and then pulled right back up. So, but if we go all the way back to 2000 when the yield curve inverted, that preceded, obviously, the tech market bubble from 2000 to 2003. But if you look very closely, the market really didn't start gaining steam on the downside until the yield curve had already inverted and actually was heading back up. So once the yield curve was heading back up and correcting itself, it was too late. The market had already started gaining steam and was rolling over. So, but what's interesting is, from the initial drop there in 2000, it wasn't until 6 or 8 months later that the market really started to kind of lose. And the same goes with the situation in 2008, right? Once the yield curve inverted and kind of bounced around down there, it wasn't until the yield curve started to head back up that the market really started to roll over. So there was a period of time, close to a couple of years, before the market actually, the stock market actually started to roll over. So, what's interesting is every market pull down, is different. And, there's a lot of similarities in many cases. But at the same time, so we had this yield curve inversion, and just right off the bat, the market started rolling over. So that tells me that there's a lot of fear in the market, and probably a lot of people just sitting back knowing that the market's overpriced, overvalued right now relative to the current economic situation. So there's obviously been a nice pull down here in the S&P, and we're just now starting to invert and so the question will be, are we going to go through a long period of time where we're just going to be kind of going through this choppiness? It's quite possible. So again, that's why we need to play those bear market rallies, but just have our finger on the trigger and be able to pull it right back off. So as you can see, market's going to throw a bunch of curveballs at us, and it's going to be pretty messy out there. So I think it's just important that you're able to move your mitt and catch the ball. So, but if you have any questions, give me a shout, and look forward to seeing you on the next Markets in 5.